What are excess reserves? Monetary policy explained. Imagine a bank has a certain amount of money sitting in its account at the central bank. Some of this money is required by law to be kept on hand, but any extra is called excess reserves. These are funds the bank holds beyond what the central bank says it must keep. The central bank sets a rule called the reserve requirement, which is a percentage of the bank's deposits that must be kept as reserves. If a bank has more than that minimum, the extra is excess reserves. Excess reserves act like a safety net for banks. They keep some extra cash ready in case customers suddenly withdraw money or if the bank faces unexpected losses. Holding excess reserves makes banks safer and more trustworthy. But it also means they are not using those funds to lend out or invest, which could earn them more money. So, there is a trade-off between safety and earning potential. In terms of how the economy is managed, excess reserves are very important. Central banks influence the economy by changing reserve requirements and controlling how much money banks hold in reserves. They do this using tools like open market operations, where they buy or sell government bonds. When banks have lots of excess reserves, they are more likely to lend money to businesses and consumers. This can boost economic activity and sometimes lead to higher inflation. Before the year 2008, the Federal Reserve, which is the central bank of the United States, kept reserves tight. Banks had little excess reserves and lent them to each other in the federal funds market, affecting interest rates. After 2008, the Fed started paying interest on excess reserves to better control inflation and economic growth. This changed how banks decided to hold reserves. Excess reserves also play a role in controlling inflation. If banks hold a lot of excess reserves, they can lend more quickly if the economy improves. This can push prices higher if not managed carefully. Central banks keep an eye on excess reserves to make sure inflation stays within their target range. They adjust reserve requirements and interest rates on reserves to influence how much banks lend. To sum up, excess reserves are the money banks keep above what they are required to hold at the central bank. They provide liquidity and influence how much banks lend. Central banks use tools like reserve requirements and interest on reserves to manage these excess reserves. This helps control inflation and keeps the economy stable.